Hedgeless Horseman here. It's April the 29th, 2025, or still April the 28th in North America. Hope you're having a good day. First of all, thanks to the sponsors. Let's check in with the metals. Gold was actually up quite a bit today. I think gold futures were up around 2% almost. Silver, I guess, up a bit. Crypto not at zero yet. Mixed bag, I was gonna say. I think the markets might have, I don't know if they were up or down actually. Yesterday I didn't pay much attention even to the gold price. I just checked in hours after futures have started trading. I just realized it was up. Anyway, I thought I would touch on, first of all, again, just to harp on about realistic expectations. And then I will spend most of the video just talking about the sweet spot as I see it right now, which is the second part of the Lassonde curve. And yeah, I'll get to that. But let's just let's just look at a few tweets first. So I thought this was as good as any time to just show. It's like I have shown this chart before. It's the Lundin Gold mining chart, and it obviously looks like it's an exponential chart because it is a compounder. Obviously it's been on average going higher every 1 or at least 2-3 years, let's say, and when you have it in nominal scale, obviously it looks sicker and sicker basically, even though this run here is not necessarily less than this run here, but yeah, since it's nominal scale again, it kinda makes it look like it's been rock and roll throughout this whole time. And as I pointed out before, as you can see, this chart, this is actually the, I should have added the one where you see all the consolidations. Anyway, 90+% of time, Lundin Gold did not make new all-time highs. If you owned it through this entire time, easily over 90% of time, I would say, you were not getting new net highs basically. So again, it looks like it's a rock and roll ride, but if you look at it, it's like this is what I think a lot of people can't grasp for some reason. It's like I remember a few years back maybe when I showed my oldest portfolio, because that's been quite a good compounder, especially since the bottom 2016. I haven't checked it recently, but for quite some time it compounded at 50% per year around that, and that doesn't sound that splashy in a sense. But this, if you look at the Lundin Gold chart here, since 2015, and we're obviously in 2025 now, so that's 10 years. It's up 1,381%. I just checked what the compounded annual rate of return would be from a move like this over 10 years. It's 31% per year. And I dare say, if anybody pitches a stock to anybody, it's like this is probably gonna do 31% over the next 12 months, and maybe 31% the next year or whatever. I don't think anybody would care. I think a lot of people would be, in a sense, disappointed if they get 31% per year in any one case. It's just in hindsight, 10 years later, they would realize that, okay, this was actually an absolutely phenomenal return. 31% compounding is world class. And I think that equates to, well, it equates to 2.28% per month. And I think I got it to 72% every 2 years. I mean, if you want to look, which might help it, wrapping your head around it. So this is around 72% every 2 years. And if you only found cases that on average returned 72% every 2 years, 24 months, your portfolio would have a chart like this. But if you pitch that to anybody, or the very idea of only being up 31% per year, etc., people who have never really made any money in the markets, that's not high enough to them. It's not good enough for them. But that's because almost nobody has any idea. It's like when I showed that chart someone, and he just assumes, like, were you all in on Kirkland Lake? Because Kirkland Lake also had a very spectacular chart over X amount of years like this. But to be honest, I'm not even sure I've had a single 10-bagger. Well, not that I own still, at least. And of course some were 10-baggers for a while. And some failed afterwards, so they went up 10x and then down 80% and stuff like that. Like, Novo, SK. But 10-baggers have not really been a thing, and you certainly don't need it. That's the thing. My point is, if you find cases that, let's say, you think they're pretty low risk in a sense, and you think, hey, I mean, in 2 years, if this could go up 72% and it looks very likely, you could have a chart like this at the end of the day. But of course nobody actually buys those cases. Like, and for me personally, it's like Lundin Gold, I thought it was never really that cheap, and I could see 50% upside, let's say, at points in time, but I never pulled the trigger. So I'm guilty of that myself. We forgo the relatively low risk, good returns for the idea of getting a 10-bagger in 3 months, 6 months. Discovery plays, very high risk plays. That's what I try, because it's never enough. If you pitch somebody a stock, it's like, I think this could return 31% per year over the next 2 years, for example. It's like nobody would really buy that. That's way too low, way too low. But in reality, it's obscenely good. And also, I guess to make a point, like I see a lot of people like lambasting the fact that their shitcos are down, let's say, because most juniors are shitcos, and they're like, all hope is lost, and no point in changing the strategy now, because they're down 70%, so they think that, well, then I need to take even higher risks. It's like when you go on tilt in poker, the more you're down, the more you want to play, the higher stakes typically you want to play. That's how people go bust. They take more risks when they're down the most. And then they take so much risks that they end up not being down, they end up busting. They play away all their money because they want to get even and make money quickly if they're behind. So I think this is actually a pretty good wake-up call, in a sense that it's literally never too late to start investing in a more rational sense, let's say. So if one started with $10,000, let's say you started in 2020 or 2021, and you mostly had high risk, let's say shitcos or whatever, and you're down 70%, so you only have $3,000 left. But then if you all of a sudden, let's say, switch your strategies, like, I'm actually going to look for companies that I think could go up 72% over the next 2 years, then you're probably going to start looking at, okay, putting me on the spot here myself, but I don't know, even like cheap producers today, or some company that could grow 50% over the next 2 years, and it's somewhat cheap today, stuff like that. It's like, you wouldn't go out there if I told you, it's like, gun to your head, it's like, you're gonna find a stock that you're gonna you can only buy 10-20 positions, and you're gonna aim for an average 72% over the next 2 years. You would probably not have the portfolio you have now. So if you did that, it's like, okay, I mean, you could do, I don't know, maybe royalty companies or something, or it's like, a royalty company is like has one royalty kicking in 2 years. I mean, obviously nobody's going to care about that today, because as I've said, most people don't care about news releases, even positive ones. There are more than 2 years out. That's why, honestly, this is probably the best reason why I think it's like I can't really. I believe I will, keep making money in a sector like this forever, because there is no shortage, in my opinion, almost at any point in this sector where you can literally not find companies or cases you think, well, this could actually go up at least 72% if I gave it 2 years. If, put a gun to my head and it's like, hey, you have to make 72% over the next 2 months, I don't really know where to begin. And the funny thing is, like, since this averages 30%, 31% per year, and you get a chart like this, at the same time, a stock like Lundin Gold can go down more than 30% in 1 month. Up or down, 30% in 1 month, and still, at the end of the day, you only need 31% per year. So it's just crazy volatile in between, obviously, because like a bunch of these moves were probably close to 1 year's worth of returns. And that's obviously what most people are playing for. It's like, why wait 1 year for a 31% return, let's say? I mean, there's 31% maybe here, 31 there, maybe 31 there. So that's what obviously attracts people. It's like nobody wants to wait for anything. They'd rather, play the market in a sense like everyone else. But that's the most crowded place there is. Instead, in a case like this, I mean, every single correction here was just a bigger buying opportunity. This would have returned today much more than this much more than that, this much more than that, this much more than that, and all of these ended up being really good buys. I mean, $20 in a year, you're up, 100 whatever, 25%. That's great returns. But that's one thing. So it's like, is it ever too late really to start investing properly? No. But does it feel like it? Yeah, I bet. If you're down 70%, you're like, oh my God, 200% just to get back to even. Then you think, oh, I gotta get that 200% in a one fell swoop. It's gotta come quick. I gotta find the most high risk cases, the long shots, for example. Whereas like you could literally start aiming for 31% per year, which is world class. And honestly, if this was a rational market, that would be really, really hard. I mean, good luck doing that in, S&P 500 or general market from just investing. That's got to be much harder. But in an irrational, illiquid, dipshit, depressed market or sector like the junior sector, I think that's impossible at all, especially at today's levels. I mean, heck, honestly, if I'm aiming for 71% over 2 years, if things go well for a story, there's also the option that sentiment will have turned around within 2 years, and you're going to be up 300-400% instead of 72. So it's like, if you aim in a conservative, rational way, especially from these sentiment levels, all the sentiment boost comes for free. It's a free optionality. That's what I keep saying. It's like I pick the micro first. If I'm right on the micro, I can make money. The macro becomes free returns in a sense. I mean, the easy money is the sentiment swings. I mean, when you make more maybe than you should actually. I mean, now I actually think a lot of juniors should be up like 100-200% without really breaking a sweat, and certainly not being obnoxiously overvalued. But this market is going to get overvalued one time as well. That's the thing. That's the easy returns. But it's like if you're conservative, assume sentiment is not going to change. You're just relying on your stock picking, like what's the actual value kind of this company, what could it be worth in the future, and you're betting on that. If you're aiming for 72%, if things turn around within that time frame, again, you might slap on a few 100% just from a sentiment swing. I think there was one more thing that... maybe not. I would also point out that in this example here, it also assumes that you deposit $100 per month. I mean, I don't know everyone's personal finances, but I wouldn't think this is totally out of the question. So if, again, in this theoretical example, if you're down 70%, you start with $10,000, you're down to $3,000. From now on, you magically happen to pick companies that will go up 31% per year, 72% every 2 years. I mean, typically what happens in this junior space is rather it's like it's even or down, and all of a sudden you make everything back in a short time frame, and then it gets harder. I mean, it's not like it's 31 just like that, like a robot. It's more like, okay, underperforming, boom, overperforming, went too high, went down again, yada yada, like we see in the Lundin Gold chart. But it's like on average, let's say 31%, and you deposit $100 per month for 10 years, and you compound 31% on that as well. In 10 years, you would have $106,000, $3,000 initial investment, or well, actually $10,000, I guess. But then you added over 10 years, you added $112,000. You would still have $106,000, and that's starting from a $3,000 portfolio with $100 deposits every month. That is, I mean, that I would take that as a really, encouraging thing. It's like, hey, because obviously if you deposit $200 per year, this would be a lot more than 106,000. Or if you become even better at investing and you're like, oh, I can average maybe 50% for the next few years, given how cheap we are overall in the sector, and then it whatever drops down to 30%. It's like, I think that's a good thing to remind oneself of. It's like it's absolutely never too late. And again, just look at Lundin Gold. I mean, it's not like everybody in Lundin Gold was making money hand over fist. I mean, from this period to here, you didn't make anything basically. From this to here, you didn't make any. I mean, you lost money most of the time, or you were down from it. So that's my point. It's like it's not going to be an easy ride where it's like, oh, you're sitting there counting your money every day, even if you're in a 10-bagger. Over 90% of days will, in some senses, relatively speaking, looking at the last high, will be a disappointment. What's not disappointing is 10 years later, you'll be up 1,381%. And of course, if you deposited money or bought some, especially if you bought at dips, even better. Anyway, what I really wanted to talk about was this, and I talked about this quite for, I don't know, a few months now, maybe. I just think it's getting increasingly relevant given how gold has done over the last 2 months. So it's like theory crafting is what I really like, game theory, whatever. I like to, as you can tell, I like to talk about investing and share my conclusions and insights and thoughts. Maybe that can help someone else, at least gets some people thinking. I'm not saying I'm always right. I'm saying what makes sense to me, and maybe that could help someone. And just give a different look on things. I mean, the way I see it is, investing is a game to be solved. I mean, yeah, I kind of see it as a game. I don't really care that much about money. I'm not very materialistic at all. I mean, my lifestyle hasn't really changed from when I almost had no money to when I have money. But I enjoy, this is the most fun part. I enjoy trying to beat the market, because the market is in a sense your opponent, it's your neighbor, and I like to figure out its weaknesses, its tendencies, and how I can take advantage of it. Because there's always, I mean, there's a saying, I guess it's a Chinese saying, it's like crisis and opportunity are it's the same word or something like that. Because everybody, as I've said many times, are bitching and moaning about the sentiment in this sector right now, that nothing is going up in price, or not much is going up in price, and that's automatically then a curse, right? It can only be a curse because your portfolio is not going up in value right now, and not last week or yesterday, and you don't think it's going to go up tomorrow, whatever. So it's like that. That's how most people view it. If your portfolio is not going up today, that's a bad thing, absolutely bad thing. If it hasn't gone up for the last months or years, that's automatically a very bad thing. Something must obviously be wrong. You should switch sector. Something is not working. And again, just pointing out that in Lundin Gold, there was majority of the time that was actually happening. So as you can tell, that's absolutely bullshit. But okay, so I don't try to predict stuff really. I mean, I've been a long-term gold bull, and of course that looks smart now since gold is close to an all-time high. But I didn't know how it was going to go to this level, or that it was going to go to this level. Not anything like that. And I certainly did not predict that ounces in the ground and juniors would be trading as cheaply as they are, given where price of gold, that I didn't know was going to go this high this quick, but it happened. So I was going to say, don't hate the player, hate the game. No, my point is that I don't try to predict all of that. I can't explain all that exactly why it happened, whatever. I can just work with the risk reward that Mr. Market is giving me. And at this point in time, again, it's like we adapt, we think about investing. It's not a science, it's more of an art, right? So I never thought I would be where we are today and see what we're seeing today. But here we are. Okay? So then the question is, okay, this is what Mr. Market is giving us. How can we take advantage of that? Is there a way to take advantage of the dislocations, let's say? So I really haven't paid too much attention historically. I mean, since I started investing in 2015, I never really cared that much about the second part of the Lassonde curve. Either I was in, very early on, I was in trading sardines. Then I was, I guess, mostly in alpha exploration plays. Then kind of recently, I mean, I sort of switched to especially given how cheap stuff was. That's like the hybrids were kind of my preferred vehicles. The one where it's like they already have something. You get a bird in the hand, and you're buying that for at a big discount, and also they have free then upside exploration potential, the free birds in the bush. So in a sense, you're buying the bird in the hand for at a discount. So you have expected returns just from the fact that it's too cheap based on what they have, but you also get the free option that it might be even bigger, or they're gonna find a bunch of more birds in the bush. So that in a sense becomes free optionality, like Lassonde talks about. I have a few quotes on my site where Lassonde says the market is very bad at valuing optionality. So if it's very bad at valuing optionality, I mean, that's how he became very rich. He took advantage of that. So why shouldn't we take advantage of that? If I can get risk-free exploration potential, why not, right? Because exploration can provide game changers, legitimate discoveries. If I don't take risks on that, I mean, that's absolutely great. Usually, as we know, most of the time you take immense risk for exploration. But today, okay, what's the status out there? Well, the status is that gold is at $3,346 per ounce right now, almost record high. The status is also that all-in sustaining costs have not at all kept up with the rising gold price. We haven't had enough inflation that the AISC is like $3,000 or something for the mining companies. There's quite a few. I mean, I think Agnico came out with their quarterly recently. There was some maybe one-time positive things, but still I think they had AISC around 1,200 if I'm not mistaken. So that's over 2,000 AISC margin on at face value for their operations. I think Newmont came in at like 1,600 or something like that. So that's like $1,900. That's still crazy high. In 2011, I think the AISC margin peaked around maybe $680 per ounce or something, but let's call it around $500 per ounce of AISC margin from gold coming out of the ground. So now some miners have 4 times that. Some have triple that amount of AISC margin per ounce. So their ounces coming out of the ground are 3 to 4 times as valuable as they were coming out of the ground in 2011. So basically, that means the gold miners are pissing money right now, printing money hand over fist. They've never made more on an ounce coming out of the ground as they have today. So it's at peak value on its peak value of gold production right now. Gold production, the cost of taking something out and the difference between selling it, peak. Despite this, as we know, and as everybody's bitching about, gold juniors, which, as the name suggests, have gold, and some have gold in the ground already, some have a lot of gold in the ground already, they're not really reflecting the fact that the gold business have never been worth more. Right? Okay. Could there be an opportunity there? Well, let's put our thinking hats on. It's like, okay, you can do what, I mean, you could play around. You don't need to think of it as gold, but it's like, if I was going to say, if I have a basement full of Nike shoes, or somebody has, and I can buy those Nike shoes for $100 per pair, and the selling price of those Nike shoes is $3,300 now. Would I want to buy that basement full of Nike shoes, and my purchase price is, let's say, $100 per pair, and let's say 2,100 in that case. So the selling cost minus my purchasing cost is $2,000. That sounds like a pretty good deal, right? I'm buying something at a price, and I can be selling it at much higher prices. In this case, buying an ounce in the ground, $100, let's say. I could be selling it if I had a mine going for $3,345, and it's going to cost me something to actually pull that out of the ground, but I'm going to be making the difference. And the difference right now for whatever the average mine might be $1,500. The really good mines, let's say $2,000. Can I force the market to care about this discrepancy? I mean, if we're thinking about, okay, if you don't have any gold at all, so there's not going to be any risk of any gold coming out of the ground anytime soon, then it doesn't really matter, right? Because you can't just magically build a gold mine and it's going to start being in production tomorrow, and you have to find the ounces first and all that. No, we know that's not how it happens. Average time from discovery to production might be 14 to 17 years, something like that. And then you have to actually find something worth mining to begin with, which is like 1 out of every 3,000 prospect or whatever it might be. So really, an early stage explorer, pre-discovery player or something, you can't really take advantage of this. It's like the market either cares or it doesn't, right? Even for an acquirer that likes a bigger company, likes to buy an early stage exploration project, for example. I mean, they know they're not going to be producing anytime soon, so they're kind of guessing what's the long-term value of gold going to be. And obviously that's why tier 1 deposits, for example, are always in high demand, and even tier 2 projects. Why? Because almost regardless what the gold price is, you're gonna make money on it. So everybody wants that. They don't want to make money just at tops or whatever. Okay, so which type of companies could you theoretically like take advantage of this in situ to out of situ arbitrage? The fact that the Nike shoes are selling for $100 and you can sell them for 2,000 if you get a Nike store up and running, let's say. Well, that would be the companies that have projects that have gold in the ground, have a project that's worth putting into production, and not just, I mean, preferably not just because gold is where it is right now. Because again, at face value, every single project out there kind of makes sense. But with that said, there's not a lot of projects that are anywhere close to being permitted. And many projects can't get permitted. And again, to start off with, most projects are bad. Yes, on paper they work right now because almost anything works right now. But that's not how an acquirer or a financier, for example, necessarily would look at it. They don't just, I mean, it's not like Agnico Eagle just sees, oh, nice PEA. You would make a lot of money at $3,000 gold. I'm gonna buy that. No, that's not how it works, obviously, because there's I don't know how many projects to pick from. But the point is still that, hey, if you could get something in production and you bought those ounces in the ground very cheaply, there might be a very favorable outcome ahead especially in case, I was going to say, gold is trading or gold margins are anywhere near these levels when they start production. Because today there's a bunch of projects out there which I believe have, like, some projects would have less than 1 year payback, some would maybe have 1 to 2, and some might have slightly higher than 2 years. So that's how long it takes for the capital investment to be repaid, and after that you're free rolling. So we've never had these kind of margins, which also means then that the payback periods on gold projects have never been quicker. Which kind of goes without saying, right? If nobody's ever made more money on a gold mine today, a gold mine has never been more profitable. That means that whatever you put in, because, yeah, I mean, whatever you amount of money you take to build it, it's gonna pay back that money in the quickest time frame that's ever been seen in this space, basically. So compare that to 6 years ago, maybe. I don't know exactly what the ASIC was, but let's say ASIC was 1,200 and the gold price was 1,700. That's a $500 ASIC margin. And let's say the in situ gold ounces, the good ones, legit ones, were trading at 100 back then as well. That's, theoretically, okay, you can buy it for 100, you get 500 in margin if you put it into production. And then, after tax and all that, I don't know how much you would have left. Let's say 350, 300 something, I don't know. So that's a few multiples of, what you bought it for. But compare that to today, where it's like 2,000. and the payback period being much quicker. So I mean, if gold price would stay here, let's say you have a 10-year mine life and you would have these margins, you would, for 10 years you would be making $2,000 per ounce in AISC margin. You bought it all for $100 per ounce, and it costs you, I don't know, 300 million to put something into production. You make that back in 1 year, so you're free rolling 9 years. That's kind of crazy. I mean, talk about it. I mean, only time really that a gold mine literally is a gold mine, that would be now. So then I think about this segment of an article. I think it was Tommy Humphries who did it when he was talking to Jonathan Goodman of Dundee Capital or Dundee Corporation or whatever they're called. And some things stuck with me here. I'm not saying he absolutely is 100% correct, and of course there's other people who go about things in other ways, but I just assume that this guy probably has, I mean, I think his father was a legend and all that, and he's done very well as well, so let's say that he might have a point. So let's look at what some of his comments or conclusions were. To him, the most important thing is how fast new mines repay their capital cost. And of course that kind of comes down to risk. I mean, if you're in Botswana or something, DRC, Congo, if you have a big project and it's going to take you, maybe it's very high capex, very remote, and or maybe the gold price is kind of low. I mean, let's say we're at $1,800 or something, and you have a very large project. Let's say there's a 4 to 5 year payback period. So you invest the money, hundreds of millions. It's going to take you 4 to 5 years at those margins, if they were fixed, 4 to 5 years for you to get your investment back, that you recoup the losses of, or the cost of the mine. After that, you can start making net money, net returns on that investment. Well, obviously, that creates some risk, meaning that, well, if gold prices go down even more, let's say, and the margins are even lower, maybe it's going to take you 6 to 7 years, or you might actually end up losing money. So like, there's still a shot that you're not actually gonna make your money back. Maybe the operation goes into bankruptcy, whatever. And there's also the risk. Well, what if some weird country, I was gonna say, nationalizes the mine before you pay back the investment? Then that's a net loss. Obviously, that's why really big like porphyry operations, I mean, the majors tend to want to have them in countries that they think are quite stable and secure. Why? Because if you're going to be mining for 50 years and it takes, I don't know, 5 to 6 years for a payback, obviously you don't want to be in a country perhaps where it's like, oh, it's a 50-50 chance if you get to keep it for 10 years. Right? I mean, it makes total sense. You want to enjoy the fruit of labor. I mean, if you're free rolling after a 5-year payback and there's 25 years mine life left, you want to get a full benefit of that 25 years of free cash flow that you now get for free, net benefit. Right? So I mean, the longer the time frame, more stuff could happen, including gold prices, yada yada yada. So it makes total sense. I mean, it's a risk kind of thing. If it would take me 1 year to get my investment back, all else equal, then there's not too much time either for gold to fall that dramatically, where it's like, oh, things have gone to shit so much that gold is down 50%, and I mean, it could happen, but it's not as likely. Whereas, like, I mean, the longer you draw out the time frame, maybe, I mean, even the big corrections in gold, I mean, multi-year, I mean, even some multi-decade moves, it didn't go from the top to the bottom within a month or something. It took years or decades to get to the bottom. So obviously it would be nice that, hey, if there's a quick payback around these gold prices and I can build it relatively soon, I mean, increasing my odds of actually getting myself paid back for the investment. And then, I mean, if you pay yourself back in 1 year, if 5 years from now that mine gets nationalized, you still had 4 years of net returns from that investment. Whereas like if the payback period is 5 years and they take away the mine in 5 years, you might have gotten your investment back. If they take it away in 4 years, you lost money on it. So it makes total sense, right? And also this, most mines start off with a 10-year mine life, and you wake up 10 years later, they still have a mine life for 10 years. Okay, what's his conclusion then? Long life mines are NPV irrelevant. Goodman says, if you can buy them for a quarter NPV, you're really buying it for 5 or 10 cents on the dollar of what they're worth. You don't need a lot of those to be very successful in this business. So, I mean, he's talking about, okay, first of all, a mine that gets into production, unless it's drilled out, like every zone is closed off, for example, there's probably going to be even more ore there down the line. That might be obvious 5 years or something into production when you're free cash flowing and you're exploring. So you're probably buying more ounces than you see at face value. And also, yeah, NPV irrelevant, because I mean the longer ahead, I mean that's why juniors don't really get much. I mean, if you have a 10-year mine life or 15-year mine life, I mean, if you start proving up ounce, a deposit that's like, okay, now we're up to 30 years mine life. I mean, the year 15 to 30 is going to be so discounted, let's say, that at face value it doesn't show that you added value, but it costs you money to drill it up. But in the NPV calculations, that's been so discounted, so it looks like you might have, I don't know, paid $100 million to prove up $70 million worth of NPV. I'm just making a number up now, but hope you get the point. Whereas in reality, well, 15 years from now, if that still has 15 years of production left, that's going to come in handy. That's not worth zero. Even remote, maybe that will be trading in. I mean, if the NPV today is 70 million, but it's like in 15 years, it's going to be trading at 500 million market cap. I mean, that's nothing really to sneeze at. Even though, yes, by the law of discounting and opportunity cost, it's almost worthless today. But if we take all this together, so it's like to him the most important thing is how fast mines repay their capital cost. Okay. Gold projects on a universal basis have never had quicker paybacks than they would have today. So I mean, it doesn't need to be a tier 1 deposit, low tonnage, high grade mine or something like that. It doesn't need to be, because like bulk projects have like less than 2 years time payback periods. Most mines start off with 10-year mine life, and you wake up 10 years later, they still have a mine life for 10 years. I mean, that's kind of typical for, district plays overall, right? That's why you kind of, it doesn't hurt to have a big land package, and that's how majors look at it as well. They're willing to pay up for a project that is de-risked if they get a big land package, because as far as they're concerned, well, any other potential satellite feed that could be discovered here, we're getting that for free as well, and we have a mine already built. So that kind of becomes free optionality in a sense, and you're not really paying for it, and there's no need really to prove up much more than a 10-year mine life in many cases, because it doesn't show up in NPV, which he then also claims that long-lived mines are NPV irrelevant. So in a sense, I mean, you buy something that's a 10-year mine life. Let's say it's a low gold deposit, which you assume, since many of them can go down at depth, if they're still open, and you buy a project, it's like, okay, 10-year mine life. It's not closed out off at depth. It's a brand new, deposit, let's say. Maybe there's twice the amount of gold actually there. So in his view, this together means that, okay, if you think if the NPV right now is $1 billion and you buy that for 250 million, But if there's a good chance that this actually is a long-lived mine that's going to go beyond the 10-year, etc., you're actually buying much more than that. Or one could say that you're actually, buying it for 50 to 100 million. That's pretty. I mean, that's pretty crazy when you think about it. So it's actually cheaper than it looks, and it might already be really cheap. So that brings me to this thing here. This current gold price kinda makes sure that anything that would be put in production today, right now, would have the quickest payback this sector has ever seen. Okay, that makes me kind of want to go, maybe for, let's say, development plays. But it also rests on the fact, since I'm not willing to pay, pay for something that's priced like it's a sure thing or something. No, I want this to be in place as well. That there's a huge discrepancy, right? Because if this was all true, that yes, 2,000 ASIC margin today, and you have some, let's say, advanced projects, and they are trading at $1,000 per ounce in the ground, then the opportunity is not there anymore. Then there is no opportunity, regardless if they have the quickest paybacks ever, basically. Then it's much more gambling, because gold might not need to fall a lot for all of a sudden. You might have started, almost overpaid for it, or the payback period is like, I don't know, not 1 year, but 4 or 5 years. So this is like, again, at the end of the day, price is the best offense and defense. This just happens to be reality, and this also happens to be reality. But if the reality was that ounces in the ground in, advanced gold projects were pricing in the fact that, well, okay, the gold margins might stay here, then it wouldn't be as interesting, right? So I'm just gonna. There's a lot of companies here, but I'm gonna try to just churn through and kind of make that point, and maybe, show some, possible cases to think about. I don't think I own all the cases I'm gonna go through, but still, an obvious case to his point about, to Goodman's point about mines typically lasting longer than they, show on paper the day, let's say, they were acquired, or the day they were put into production. Discovery Silver, which I talked about recently, I mean, they are literally buying past producing mine, like this Hoyle Pond, I guess started commercial production in 1987, and still have a 10-year mine life. Okay, not like huge endowment, but who knows, maybe they'll find even more. Do you think when they put this into production, they knew they had like, how many years there is, like 30, 40 years of production? No, 100% sure that was not on the books, if you know what I mean. Borden started in, I guess, 2019, still 8 years remaining mine life and potential for more. Pamour, new open pit currently in development. Okay, I guess this is a new one, and the Dome mine, I think that's one of the very famous ones that's been in production in some way, shape or form. I guess this might be, again, I don't know. I mean, parts of these projects probably have been, the original, let's say, deposit they were built on, then they found another deposit perhaps that's not even in production yet, thus again proving the point. I mean, they still paid, I don't know how much they paid, but if you take this project back to its 1987 days, I mean, based on an MPV metric, it would be worthless today of any ounces that come out of the ground in 2025. But still, obviously, it has value to someone today, including Newmont, who's now selling the stuff. And again, these are not new mines, but they believe they still have more to give. I mean, that's basically why they acquired this, and it's down to, I don't know, 1.5 kilometers. I don't know how deep this is, but it just kind of proves the point. Maybe they had this when they started, who knows, and then you just found, oh, there's twice the amount actually, because I'm pretty sure they didn't drill off this entire thing before they put this in production, because I believe since 1987, right? Because this is the oil. And I don't know what this one is. Is this the... Okay, Pamore and Dom. Okay, two different projects. Potential to extend mineralization. Potential to... okay, this is more of a de-risking situation, I guess. And then there's substantial upside, regional exploration. So who knows? Who knows how long these projects are still gonna continue to produce gold, how many more discoveries it's gonna get. So it's like at the end of the day, who knows how much value is actually gonna be derived from this very land package. And if this started in operation, let's say 30 years ago, none of the current picture really would show up in the MPV. But obviously it's worth something today because the market cap is $2 billion. That's nothing to sneeze at, right? So imagine if you had these projects and it's like, 1 year payback at record gold prices, and then you're free rolling a whole camp for 30, 40 years. I mean, you literally could build a dynasty on that. And then of course Magna, which is kinda, Discovery Silver is pretty much a Magna but in gold. And as we know, it's like, okay, Magna had what? Well, it started with FNX Mining. The Morrison deposit was their discovery. Here you can see FNX drill holes. And then KGHM bought them. And then Magna bought them from KGHM. So it's like at least a third company that's working some of these projects. And they still believe, like here, underexplored Sudbury breccia trend. So Magna obviously believes that there's, no guarantees, but they believe there might be a lot of potential left. And I don't know how long, some of these projects will have been in operation already. So who knows? Maybe they find another Levack mine. Or I would say, whatever you would like to call it. I thought I had even more slides, okay. And then just, add on all the other projects like Green Hill, historic mine, still has a lot of stuff left. Shakespeare, it was in production for a short period. But Podolsky's been in production, Levack been in production, McCready West is in production, has been in production for a long time. So imagine you owned all of these assets from day one, just kept finding more, and again, let's say they produced for 30, 40 years, you bought them, now I'm talking really long-term investing here, and that's assumes good management teams, and they were, treated well, and yada yada, survived the downturns, etc., etc. But like, hey, imagine you can buy some of these projects, and it's like, okay, you paid it back in 1 year, if we pretend this was gold, and then you're free rolling for 40 years. So it's like maybe your grandkids can, enjoy dividends at some point in time. And if you bought it at real cheap prices, let's say the company grew, who knows how fat those dividends might be. I'm just trying to get people to dream a bit. But everything I'm talking about here makes no sense to a trader, right? They don't care about price to value. They don't care about anything really. They'll happily buy something expensive if they think it's going to go up, and they'll happily sell something cheap if they think it's going to go down. But I'm talking about when gravity actually hits, like something going from in situ to out of the ground, then all of a sudden this will matter. Now it's kind of theoretical, but if you can close that gap, the rubber meets the road. Integra, maybe the poster child in a sense, since the fact is that they already have cash flow. They're enjoying the record high gold price. Florida Canyon has having margins, free cash flow margins that's probably 3 to 4 times than what they budgeted it for. Yes, gold price can go down, etc. But now it's been a huge upside surprise. And who knows, a year or two more of similar type of margins, and they might have be able to pretty much self-fund DeLamar. And that's a much bigger deposit with around half the ASIC. Maybe the ASIC will be a bit higher, but it's not going to be 2,000 like Florida Canyon. And Florida Canyon might get better and get extended and yada yada yada. So it's that's the perfect crime in a sense. Okay, you're getting nothing. Well, you're really paying nothing for DeLamar or Nevada North, but they are enjoying the reality of the record high gold price. And if the market ignores this, they can still use this reality to maybe fund one or both, or a lot of one at least, to make that a reality, to close this gap. Because let's face it, if the market doesn't give a shit about DeLamar, but let's say that's in production in 2-3 years, and Florida Canyon, let's say, have been extended, and they're able to self-fund Florida Canyon, DeLamar. Let's say they're making 200,000 ounces per year and have, 3 times the cash flow they have today, or 4 times the cash flow, who knows? We don't know what the gold price is going to be. And they pretty much self-funded that. Do you think the stock price will be higher than it is today? Again, assuming there's not too much dilution. Yes, I would think so. Do one think one could get close to, a run rate of 31% per year or 72% per 2 years for a case like Integra, for example? Yes, I wouldn't bet against it. Would Integra be nearly as interesting if they didn't have the Florida Canyon mine enjoying these record high gold prices, or the gold price? The gold price was actually at $1,800 or something, and DeLamar would have a, I don't know, do they have the payback period actually here? Okay, this is Florida Canyon. After tax 2-year payback at, what's the gold price? I guess that's 1,700. So what do you think the payback period for DeLamar is at these gold prices? Easily sub 1 year, right? I mean, what's the production profile? 136,000 ounces. I'm just going to do a quick ASIC margin calculation here. Okay, so we have a gold price of, let's say, $3,300 minus, let's say, $900 ASIC. That's $2,400 in ASIC margins at today's gold price at 900 ASIC times 136,000 ounces of production. So that's 326 million USD in ASIC margin. Oops. Per year. Oh, I didn't crack my phone, at least. Per year. What's the... Do they have the initial capital cost? I don't think it's that high, actually. Okay, they don't have it in here, but it's what did I say? 300. I'm just going to see what that's in CAD. So that's, 326 million. Let's divide that by 0.72 or something. So that's around 453 million CAD in free cash flow. I think, I don't remember what the initial capex is, but I don't think it was that high. It's like 300 million or something. Not sure if it's CAD or USD. But face value, 1 year payback, and then you're getting whatever 300 and 400 if the gold prices would hold up. Life for mine average 400 million, let's say, of free cash flow per year. That's the market cap of the company right now. Imagine you can self-fund it. Do you think it's going to be trading at 400 million in, let's say, 3 years if that happens? And they have Florida Canyon up and running and making money, and now have Nevada North, let's say, so advanced that might get see production start a year from then or something. I don't think so, right? Can I see, let's say, average 31% per year over the next 5 years in Integra? Yeah, for sure I can. For sure I can. Is it a high risk exploration play? No. It is a bit reliant, of course, it is reliant on the gold price. But hey, 2 years worth, 2 years more of similar type of margins, maybe they, again, can fund a lot more. Amex Exploration, which they have put in, I think, over 100 million in exploration, and they drilled over 500,000 meters. I think the market cap's around 125 million. So they're basically trading around sunk costs. Okay, let's look at the economics. After tax NPV at 3,000, that's 1.1 billion. So it's trading for around 10% of the NPV at $3,000 gold. Keep in mind, this is a PEA, so they tend to be a bit optimistic, but at the same time, they're planning to do another MRE this year, and I assume another economic study, and I think the MRE is gonna, if I was a betting man, I would bet it looks better than this. Otherwise, why do another resource estimate? So I think the project is going to get better on paper, and even though it's PA, this is kind of absurd. Where's the after-tax payback period? 1.2 years at 2,600, and this is $600 more than the base case, and then it was 1.8, so it dropped 0.6 years in payback time from a $600 move in gold. Let's say we add 600, then we're up to 3,200, and reduce this by 0.6, then we have a after-tax payback period of 0.6 years. So before the first year of production is over, you paid back the cost of building the project. Your whole investment in building the mine is paid back, and you're free rolling after 0.6 years. And it has 10-year mine life, I think. Oh. 10-year mine life, and note, which helps with the PA, the diluted grade is expected to be higher year 1 to 5 than life of mine. Annual production 100 and total production, so 1 million ounces over around 10 years, and 101,000 ounces per year. But years 1 to 5 annual production is 124,000, which helps again with the costs or the payback, since it's higher grades. And years 1 to 5 AISC of US 739. So let's assume this is gonna be somewhat correct. We can round up the AISC costs a bit. Do I have? No, I don't. Okay, calculator. Let's say $3,300 gold minus, let's say, 800 in AISC, $2,500 AISC margin times 124,000 per year in the first 5 years. That's 310 million USD AISC margin in on average in the first 5 years. Divide that by 0.72 to get CAD, then we're up to 430. Capital cost, initial capital is 229. I'm not sure if that's CAD or USD, but it doesn't matter. At these gold prices, again, this would be a sub 1 year payback period. And then you're free rolling. So it's like 124,000 ounces worth of production would pay back the initial capital. Yes, it's going to cost then, sustaining capital and all that. But some of the high grade stuff, for example, this is, very, very high grade. You're not going to be losing money on that anytime soon. Here they have a cutoff grade of 1.29, and obviously this is a lot higher than 1.29, so one could assume that these grades should work very well. So basically, let's see here. Let's say this is 1 year's worth of production. So you invest 229 million. You make, let's say, 300 million from this. You paid yourself back. Your investment has been recouped. Everything from that point on is free cash flow, net upside to your investment. And that would be like anything and everything that's going to be mined after. Plus high-grade zone divide to vertical depth of 1.3. They've hit assets, high-grade assets down to 1.6. So you can assume, again, as per Jonathan Goodman's comments, that mines have typically longer mine lives than you think. And these are, I think all of these zones are kind of open at Grey Cat open. Okay, where's Gratian? Eastern Gold Zone, high grade zone, and again this is open. The Nice Zone. Oh yeah, Gratian. So this is they've drilled 18,500 meters. I don't know what the average depth is here, but let's say 250 meters or something. Who knows how deep this goes? Could be a kilometer for all I know, and I would still get that for free. So imagine, I can't point this out enough. It's like, how many investments would you make if like somebody's like, hey, give me $229. It's gonna take us, I don't know, let's say 1.5 years to start up production, because this is a low capex, small scale operation. You're gonna get your money back in less than a year, and everything else in terms of free cash flow this mine produces goes to you as well. So who knows how many times your investment will have been paid off before, let's say, a mine like this actually runs out of ore and you can't get any more free cash flow. I'm saying it's just absurd. And then, take this potential arbitrage here for some juniors, combine it with that long-lived mines are even cheaper than they look, and that, according to this guy at least, the most important thing is how fast new mines repay their capital cost, and it's never been quicker than today. So why wouldn't I be kinda interested in developers or advanced explorers? But the key thing is, if they can't get permits, they will never be able to close this gap. Never ever. Doesn't matter if the gold price is $16,000 per ounce. If you can't permit it, never gonna happen. If it's a really shitty project, it's probably never gonna happen anyway. Nobody's gonna buy it, because like if there's 50 decent, I think that's might be too much, but let's say if there's 30 tier 3 to tier 2 assets out there, and you have a pretty shitty project that looks great on paper because gold is 4,000, I don't think people are going to start from the bottom. If we're talking major companies, like, oh, this shit project makes money at today's gold price, I'm going to buy that before I buy the 20 other projects that are also, could also get permitted or might be permitted and are better. and we can survive a downturn much easier. No, I don't think so. So I am not going the full optionality play where it's like I'm gonna buy the shittiest project out there because it looks great on paper. Because the thing is, if the sentiment, let's say, would not turn around in 3 years and that project never gets built because nobody wants to buy it and the ones who own it can't finance it, then this again will always be a theoretical arbitrage, even though it's not necessarily an arbitrage because it's not risk-free, but I hope you get my point. So I'm interested in the ones who have a legit threat of closing this gap. Either somebody acquires them because they want to close this gap, they know they're getting if they put this into production, they could maybe get margins like this if gold hangs around here, but they know they're paying this much, so it's like, oh man, that's a pretty high margin of safety. That's honestly why, for the first time almost that I can remember, it's like, if we're talking legit gold projects that can get permitted and maybe you don't have to wait like 5+ years for them to get into production, I don't think I want to get a 100% premium. I mean, that even if, again, it's like, let's take some of these projects. Let's take Amex or whatever. It's like, okay, they buy out for 250, then somebody builds that project for 250, and they make 300 million per year. I'm gonna feel shortchanged, because that mine, who knows, it might be in production for 15, 20, 30 years. Nobody knows. But am I gonna sell that for 250 million? Or do I want to sell that? No, I would actually kind of want to own it from an investing perspective, because it's sure as hell gonna be some good returns. And of course that's why it's like, if you can kind of tell, I wasn't, again, I necessarily weren't too sold on advanced projects or something like in closer to the second Lassonde curve. What is special about First Nordic though is the fact that it's a tier 2 project, and you get a free optionality from all the exploration and all the exploration within Barsele for it to become a tier 1 project. And this is a high quality project. This should make money on much lower gold prices. And again, given the land pack, given that Barsele is wide open at depth, actually I think it's open along strike with maybe some gaps, plus you have multi-kilometer targets over 100 kilometer strike. So if we go back to Dundee's or Goodman's comments, so if I'm buying this for 15 cents on the dollar, and it's, if you account for the not only the upside just in Barsele but for the district itself, how cheap is this really? And yes, this is a project that is very likely gonna become a mine. It's too good not to put into production. All the surrounding municipalities are pro mining. They already have a mining concession, so what you're really waiting for is, well, you kind of want to know what you have, maybe even in more detail, you know what I mean? It's like, do you want to prove up maybe 5 million ounces is, of course you should, this is a mine already. That's the thing with AMX as well. So the question is like, how much technical infill work do you want to do before you actually design the mine plan and then send it in for environmental permits? That's the only permit that's left, I think, and I don't think that's gonna really be a problem either, because Agnico has had 10 years they worked this ground for 10 years, so they probably they must have done all the whatever flora fauna studies, hydrological studies, yada yada. But of course you're not gonna ask for a permit before you actually have come up with a mine plan, you know what I mean? So this, I would say, Barsele is kind of It's like, I think Adam said, it's the most well-studied project in Europe. I don't remember if he said that, somebody at Agnico had said that or whatever. But that's the thing, it's like this is actually more advanced than it looks, and I think they've also said that, I mean, when you look at the other stuff that's been done, this doesn't even have a PA out, but a lot of stuff that's already been done is like PFS stage. So that's the thing, it's like once somebody decides like, okay, we're gonna put this into production, I mean, basically we don't need more, we're gonna put this into production, boom, you're heading for a feasibility study, permitting, in construction. That is, especially this part of Sweden right now, is kind of hurting because the Northvolt collapse. And yeah, pro-mining municipalities, very, very de-risked, only need an environmental permit. So this is very much one that this is not just theoretical. This, as soon as this is consolidated, or yes, theoretically, if Agnico wants to build it themselves, this is gonna become a mine. So this is gonna be closing one day, and it's typically, you know, a gradual close and all that. And this is a project again that, I mean, I think the ASIC will be around, I don't know, $1,200 or something. So right now it would indeed have around a $2,000 margin. If gold drops by 500, that's still a $1,500 margin. So it needs to drop quite a bit. Again, the resource, this very resource, was done assuming a gold price of $1,300. So this resource only included zones and ounces that were expected to be economic down to $1,300 gold per ounce. Of course, that's 2019, so there's been inflation since then. But gold is also not at 1,300, it's at 3,300. Gold is up more than 100%. Inflation is not up 100% or 200%. So yeah, this is one. Again, these who have threats. So this actually does matter because they're good enough projects that would get into production. Plus, they're not as risky as it seems because they don't need these record high gold prices. Thesis Gold, also noteworthy. Okay, strategic investment by Integra Gold. Well, Thesis is it the one that have two projects? Ranch project, lower projects. I'm not 100. It's been a while since I looked into it. I'm not 100% sure, but maybe it's they have two deposits that goes into 1 mil or something. Anyway, let's look at okay, they invested $24 million. Let's look at the PA. Where is it here? So this is 2024, assuming $1,930 gold, $24 silver, pre-tax payback period 1.6 years, after-tax payback period 2 years. What's that at $3,300 gold? I don't know. It's like initial capital 600. It sounds like a lot, right? Let's see just what the life of mine. And I'm gonna round the ASIC up to at least 1100. But okay, sorry. Okay, so $3,300 gold price minus ASIC of, let's say, 1100. $2,200 margin times life of mine or annual production $215,000. That's 473 million USD or 656 million CAD, which is above which is more than the initial capital. And of course, yes, again, PAs tend to be optimistic, yada yada, but still, it's like around 1 year payback if these numbers are kind of close. Mine life 14.11 years, so you're getting your money back after 1 year at these gold prices, and then you're free rolling for 13 years. And if the margins would stay here, you basically would get your investment back every single year for 13 years. So you put in, let's say, you put in $600. Year 1 of production, you get $600. Year 2, you get $600. Year 3, you get $600. Year 4, you get $600. It's absolutely crazy. It's absolutely crazy. Again, it's like, I think some of these juniors, the legit juniors with projects that can get into production and not in the too distant future where gold would have time to go down 50%. Maybe, and before that happens, maybe gold actually goes to $6,000. I have no idea, but it's like, imagine the money printing machine and how much of a free roll some of these mines could be if gold doesn't crater or inflation goes up a shit ton and gold doesn't go up. It's absurd. It's like, it's pretty goddamn ridiculous, actually. How many of these do you need? It's like, let's say you have from production start, you have 3 years of really high margins. Like, you'll get your investment back, and as soon as gold price after that doesn't drop to 1100, I guess, you're still making money on that investment still. And who knows? That might grow. They might find more stuff. Maybe they find another, 2-3 satellite deposit at the end of the day. And all started with your initial investment, and then it took care of itself, because all the exploration comes from the free cash flow, which you're already free rolling on. So yes, 1/3 of the free cash flow goes to exploration, whatever. That's still net free cash flow. Then we have like Cabral Gold. Okay, they just did I think they upsized it even, upsizing the best efforts financing to 13 million. As it says here, near-term production. Material in blank is unconsolidated, suggesting low mining and processing costs. So, and I've talked about this for ages, I mean, that's kind of the blue sky scenario. A junior that gets out of the, let's say, dilution spiral, put something into production, and could be a self-funded growth machine, because they have a shit ton of targets. They have hard rock deposits already. Hard rock 230,000, oxide 135,000. Central trend, I mean, some of these haven't really been followed up even. So who knows? I mean, let's say they have oxide production for 10 years or something, and make money on that, and they can spend all that money or most of it on drilling. Who knows? Who knows how big it could get? I mean, is GMIN gonna take them over in that case? Yeah, I mean, why not? So it's just, I mean, again, I'm very paranoid about the gold price and the gold margins, but it's like the upside scenarios for some of these, juniors that could get into production, because I'm not seeing that big of a reaction from the I mean, how many gold projects do you see get a go ahead because gold is up at these levels? Newmont still selling assets that are already in production. Barrick just sold their 50% of the Nova Gold deposit or their Donning Creek deposit to a US billionaire, who apparently appreciates the value he's getting for 1 billion more than Barrick. So who's the smart man in that transaction? I don't know. I mean, looks kind of cheap for a 40 million ounce gold deposit. which could theoretically be producing 1 million ounces per year for 40 years. And again, that's what I'm thinking. It's like, okay, maybe that's what John Paulson's like. Maybe he wants to put that in production. The capex is huge. It's like 10 billion, I think. But at $1 million or 1 million ounces of production, I don't know what the free cash flow would be at today's gold prices, but a shit ton. So let's say you pays that capex back in like 3 years or something. Well, then you're free rolling for 37 years with 1 million ounces per year. That's some considerable freaking cash flow. Tocvan Ventures, which is one of the newest holdings for me. I've only got a starter position so far, but they came on as a banner sponsors as well. So what I like about this, they're also on that very same page. It's like test mine. They plan to do test mining in 2024. This is actually a project that for a brief period was explored by the Landines. And yeah, I mean, is it a tier 2 project? No, I wouldn't say it's a tier 2 project, but it's like near surface. I'm assuming heap leachable, head grade, 62% heap leach recovery, 95% gravity with agitated leach recovery. Sonora, well, I don't think it should be that big of a problem to get this permitted. Actually, Sonora is, from what I gather, a pretty good place to be mining. So it's like, hey, put this into production. Even if you have like 500 to 1 million ounces, let's say a low capex mine, rush it to production. Yeah, you can for sure you would make a lot of money at these gold prices, and then you would again be free rolling. As soon as the capex is paid back, you'll be free rolling the rest of the deposit and this district. NexGold, another interesting one. They have 2 projects there. I don't think none of them are fully permitted, but kind of as close as it can get or something. So they have 2. One here after tax NPV at 1750, 336. Initial capital 335. Again, what the NPV is at. Do they have a? I don't even think they have a. They don't even seem to have a sensitivity table. Yeah, but you can just imagine. It's like, is this the world's best deposit? No, I wouldn't think so. But like 100,000 ounces at these gold prices, AISC of 1,000, let's say that's 1,200. That's still $2,100 margin today. So that's pretty much gets the initial capital back in 1 year, and then you're free rolling for 12 plus years. And then they have this as well, which obviously if they get one into production, that could probably quite easily self-fund other project. And you get a similar, I mean, a bit lower cost, around 100,000 ounces of production. So it's kind of, I mean, it's sort of a, I guess at face value, it's sort of a Integra, but without, cash flowing already. But that's the thing, one thing. I mean, if we knew the gold prices would stay at these levels, or margins would stay for 5 years, I mean, some of these are going to be incredible investments because they're probably going to get financed and permitted, and they're going to have 1 year paybacks, and then you're free rolling. What I do not like, of course, is that I want to be free rolling a legit, a good, let's say, project where it's like I don't want to be free rolling only if the gold margin, gold margins are record high. I want to be free rolling in a sense if gold drops $1,000. Because let's face it, if let's say we have very high gold prices for the first 2 years of a mine getting into production. So let's say they make, they have a 1 year payback. So you're free rolling and you're making your investment back year 2 in net gain. And then the margins drop because gold price goes down or inflation goes up, and you drop that to half, that's still a pretty freaking good deal. It's like year 3, you doubled your investment already. You put in, let's say, 300 million, you get 300 million back year 1, repay the investment. You get 300 back year 2, which basically double your investment on a net basis, and then it drops to 150 for, let's say, 8 years. That's a pretty good return on investment still. It's like 50%, at face value, free cash flow yield on your investment from year 3 to 11. That's pretty absurd. GMIN delivers robust feasibility study, and they also have a sensitive. This came out today actually, and this is a proper feasibility study. So this is not a PA. This is gonna be a bit more conservative, more realistic, yada yada yada. And then they have sensitivity table. So at like $3,200 gold after tax NPV of 3.5 billion. That's around the market cap of the company right now, and they already have the Tocvan deposit in production. Free cash flow per year at 560 million USD. Imagine if this were to happen. Yes, it's a $1 billion capex though, but I think they're making money on the mine they have now. But let's say these gold prices hold up, or these margins. If they're making 560 million, what's that in? Let's see here. 560 million USD divided by 0.72. That's 777 million CAD per year in free cash flow. Per year, 77. I think their market cap is 4 billion right now CAD. And this would be in addition to the mine they already have. This is also one of those like, hey, I think GMIN could easily double. And I think they have the time frame, or maybe did I have maybe it's in the presentation. No, here's the timeline. Main construction, commercial production. So end of 2027. And that's okay when it's commercial production, but commissioning. But it's like, again, it's like if gold prices hold up even remotely around here, I think this is another one. I wouldn't be going back to the Lundin Gold mining. It's like, it looks expensive, not expensive, but it's like you look at it, it's like $4 billion. It's like, how on earth am I gonna make money on $4 billion? That's like, way late to the party, yada yada. But when you think about it, just look through the numbers and then figure or account for the fact that this is GMIN. They are the best mine builders in the world. If they say this feasibility, the numbers here, you could almost pretty much take that to the bank. And they would be the ones who can execute, right? So I would not be surprised at all if GMIN doubles over the next 2 years. Maybe more than that. Maybe they buy something else. Because I don't know what they're making from Tocvan right now, but let's say these together have free cash flow of like $1 billion per year. It's not going to be trading at $4 billion. It really is not. Do they have what's the payback period? $1.9 years. 1.9 years. So you're free rolling after 2 years. You're free rolling 560 million. If these margins persist, these gold prices, you're free rolling over $500 million in USD per year. And what's the mine life? 12.7 years. And I wouldn't be surprised if that got expanded either. That's the thing. This is a snapshot. They're likely going to find more, so you're actually getting even more for free. Discovery I already talked about. Mandalay Resources. Okay, I went back and it's like Mandalay Resources is actually merging with Alkane, and Mandalay is the one that owns the Björkdal mine in Sweden, east of Barsele, and the Costerfield mine in Australia. Mandalay Resources acquired GMIN Mining in 2014 for 70 million CAD. Björkdal, the mine they acquired, has been in production since 1983. Now the costs, I think they're investing quite a bit in the mine. It's up to 2,000, so around Florida Canyon. They're still making bank on this 40 years after. Well, somebody's making money from this mine 40 years after. And they bought this in for 70 million in 2014. I don't know what the free cash flow. I don't know the free cash flow. I mean, since 2014, but it's been into production, so I'm assuming they actually at least made money. And today, again, 10 years later, they are making money on Björkdal still. Okay, now they've already updated it. Yeah, okay, I can't see really the historic. Okay, yeah, operators. So they've been making 40,000 ounces per year, and what is I don't know what I think they've even said as much as like there's I think hundreds or thousands of small veins, and this could be quote going forever, let's say. So I mean, it's not in this current form. It's not economies of scale type operation. I mean, it's pretty small, but it's like, hey, if I could make money forever, regardless how small, that's worth quite a bit, right? Yeah, a large gold system with long reserve life. So I mean, who knows how deep this could get. So one deposit that somebody's been making money on and off for 40 years. And I asked ChatGTP. I asked it, I think what was long-lived gold mine still in operation. Porcupine operations, years in production 115, going back to what I said, and they still believe that has more to give. Macassa mine in Kirkland, 92 years. Imagine if you found Macassa today and you paid that mine off in 1 year. You bought it. It's like you bought it for whatever, peanuts. You bought it for 10-15% of the NPV. You scrambled up the money, you put it into production, you repaid the investment in year one, and then you were free rolling for 91 years. I mean, theoretically at face value. Sigma Lamac, 90 years apparently. Modern production since 2019, still going. Red Lake, 76 years. Because, I mean, yeah, that made Goldcorp into a $1 billion company, and still Evolution is making money on that thing. Hemlo, 40 years. It's like what he said. And of course, the thing is like, do I expect myself to hold a stock for 90 years or 40 years or whatever? Not really, right? I mean, if it's... most of them will get acquired, that's the thing. Most of these deposits, I bet, have been acquired back and forth. But and they are also acquired because of the fact that they are long-lived mines or good mines that end up having being long-lived, let's say. But imagine that you owned one yourself. Imagine you owned the Macassa mine. You would probably, I mean, depending on what kind of depending on how much you paid for it, but you might been making money on it for 91 years. That's kind of crazy. Talk about a good investment. And let's say again, going back to the payback period. I mean, how ridiculous isn't it? It's like, okay, you buy something. Let's say it has a 30-year mine life. You buy it, put it into production. You pay your investment back in, let's say, the first year, and you only get net returns after that. That is pretty wild. Gotta say, that is pretty wild. Goldex underground mining began at Goldex in 2013, still going. They still have very high margins, I think, at Goldex. Not a huge deposit. Yeah, 115,000 ounces of gold, 21,000 tons of copper okay. Over a 5-year mine life. So okay, I guess this is AU equivalent, but still going. Lassonde, commercial product in 1988, still going. More than 8 million ounces. That did not have 8 million ounces when that started. So, I mean, again, imagine you put Lassonde in production. Imagine how much Agnico Eagle has made out of Lassonde. 18 million ounces since 1988 or some. I don't know if they put it into production. I actually think they put it into production. Still making a bank. Macassa mine. Okay, here, 1931. What did it say here? In 1933. Okay, I guess I believe this better. Since 1930, almost 100 years of somebody making money on that mine. And making a shit ton today. Imagine you bought that, again, imagine you bought that and have been, doubling your investment freaking every year if the margins are high enough. Kittilä mine, large gold mine, it achieved commercial production in 2009, becoming Eagle's first mine, yada yada yada. Well, I don't know how up to date this is, but like they have mineralized envelope outlined down to 2 kilometers. It's been mining since 2009 and still going. I think the mine life is out to 2036. But then they're gonna have to. I mean, it's getting quite deep, right? 2036, 2009, 27 years of production. I don't remember how much they paid for this, but it wasn't. They bought Riddarhyttan, which George Salmis of Integra Resources was on board. Yeah, I don't know. I don't remember how much they paid. Maybe 100 million CAD or something. I don't actually remember. But imagine what they're making now on. Let's see here. I think they're producing around 200,000 ounces of. 200,000 ounces of. I think they have ASIC of like at 1,200 or something. So let's say $2,100 ASIC times 200,000 ounces of production. That's 420 million USD free cash flow per year if those numbers are correct. And again, put into production 2009, still going, still expected to go for like, I think 11 more years. And this is refractory. So it's probably, in free cash flow today, it's probably making 4 or 5 times what Agnico Eagle paid for it when they acquired it. I don't remember exactly when they acquired it. That's pretty crazy, right? It's like, let's say 20 years later from they first bought it, they're making right now on an annual basis 4 or 5 times per year of what it cost them to at least acquire it. Then they actually had to build it. But hey, I mean, I don't know what it would cost to start it up today, but of course you would be starting at surface. Maybe it would have a payback period of like let's say 2 years, something like that. But it's just crazy. It's like, is that worthless? I mean, it wouldn't show up in the MPV, but if you're making this kind of bank, yeah. So, I guess my point is that, like, if there was ever a time to think of, if there was ever a time where a gold mine was actually a gold mine, that would be today. If there was ever a time where I would be excited actually of thinking about junior mining stocks or projects from a ownership perspective, it would be now. Because most of the time, let's face it, or I mean everybody all the time almost, it's like you're flipping paper. But actually, for maybe the first time ever, the value proposition is crazy. I mean, like legit. Usually, I mean, we always say this sector is, shit. It's hard. It's yada yada, and it usually it is. But what I'm saying is, at today's gold margins, a project that gets into production could pay back that investment in 1 year, and that is not a typical thing. And I mean, not only that, but they're not at all reflecting that. Again, if some advanced, probably gonna get permitted, good gold projects out there were trading at $700 per ounce, it would be a completely different thing. But it's like the retail sector is asleep at the wheel, completely ignoring the fact that, hey, there, some of these projects have a chance of going into production. I actually think like Radisson as well in Quebec, I think they're looking at toll milling, because they have a resource around 10 gram per ton. So it's like, yeah, that's what I want to see from juniors. Appreciate the fact that if these margins hold up, you could have payback periods of like a year, or at least sub 2 years. And if you have a low capex project, yada yada, no, it's just absolutely incredible. If you have a low capex, quick payback, potentially long-lived asset, I mean, again, from an owner's perspective, an investment perspective, would I like to buy Kittilä, for example, dirt cheap in 2005, put that into production, and years later I would be making 4 times my investment back every year in free cash flow 20 years later? And that's every year if these gold prices persist. Oh, I am actually, again, it's like I never really thought I would get that interested in the second part of the Lassonde curve. But hey, I mean, I'm seeing some juniors out there, they have had a few good holes. They're trading for a few tens millions of dollars. But they're still, years and years. I mean, they're years away from having any meaningful resource. They're maybe a decade from being in production. And you have some other juniors who are like advanced juniors, could get into production maybe in the next 2 to 5 years, selling at sunk cost with legitimate projects, legitimate birds in the hands. And who knows, maybe gold price is going to be even higher in 3 years. Let's say gold goes up to $6,000 and ASIC goes up to $2,000. That's still $4,000 margin. Imagine one of these projects you could have picked up who had a path to production in the not too distant future, let's say 2 to 5 years, and gold keeps kind of going higher, and you end up in a future where it's like, okay, they're about to go into production and the expected margin is $4,000 per ounce, and you bought it 5 years later for like $100 in $100 per ounce in the ground. And that project would have a payback period of, again, let's say less than 1 year, and you would be getting like let's say $3,000 in free cash flow per ounce, from that year, and you bought all that for like $100 in the ground. Of course, there's gonna be, you're gonna repay the investment first, and there might, usually there's some dilution, etc. But it's like, it takes a lot of dilution to take away that. And again, maybe that mine will be producing for a long time. Maybe they'll use that cash flow to build another mine or find another deposit or whatever. It's just, I have no idea what could happen in some of these juniors who have actually a way to monetize. I mean, let's be honest, like most of them probably gonna get bought out if they get even close to, starting production, and the margins are where they are now. Assuming they haven't run too much. I mean, that's what I've heard about Pure Gold Mining, for example. That the Pure Gold Mining team never really intended to go into production. They kind of de-risked it and went that way, but assumed that they would get bought out. But I think Pure Gold actually traded up to like $1.2 billion, and no mid-tier or major was prepared to pay that much, and maybe then some if they would needed to give it a premium, which kind of makes sense today because West Red Lake is putting that mine into production, and they might even be in production or close to it, and they have a market cap of 400 million, I think, and that's with gold at 3,300. So in hindsight, it kind of makes sense, but they simply assume that, okay, we're going to get acquired, but then maybe the market assumed too much from the asset itself, and they apparently, from what I hear, cut a lot of corners, rented a bunch of equipment, costs were much higher than they should be, yada yada yada. So it ended with a bankruptcy, obviously, because gold price wasn't doing well and all of that. But like, if that went up to, in a hot sentiment environment, that went up to $1.2 billion, and today, kind of the same asset with much better fundamentals from a gold price perspective is trading at 400 million. I think that's another example, just again, how much sentiment actually means. Maybe it was absolutely crazy that Pure Gold was trading at 1.2 billion, but it still did. Now I think it's crazy to the other way. Anyway, very, very long rant here. Thanks for listening. I hope you get something out of it. Again, if you're a trader, this is not going to make any sense. Yeah, I mean, consider me biased. I own shares of a lot of companies I mentioned. Some are banner sponsors as well. I'm not saying you should be buying all these projects for whatever. I'm saying it's like, this is what I find interesting right now. As far as I can tell, this might be the sweet spot from a risk-reward perspective. That might not end up happening because, let's say, gold goes down a shit ton. Enough so that, I don't know, I mean, it would have to go down a lot, obviously, to make them look expensive right now, because some look cheap even if gold is at 1800 or especially 2000 even. Still, I mean, there's no guarantees, and there's no guarantees they will get into production, yada yada. I'm just saying, it's like, yeah, I think this gap has probably never been higher. So that's why I'm, not that I planned it, but looking out there, okay, what is the biggest, where's the, the junior sector the most clueless, perhaps? And sure, I mean, people can say that, well, it means that everybody thinks the gold price is unsustainable. Okay, part of that might be true. I don't buy it really, but hey, part of that might be true. But that doesn't mean it is unsustainable or it's going to correct soon. And even if it does, maybe they've been so discounted from that fear that they're even cheap regardless. Let's say. I mean, I don't want to. I want to look at how much could I make if things go right. How much could I lose if things go wrong? I don't necessarily care what the market consensus is. I just care about how much do I make if the consensus is wrong, in a sense. Because the same thing is here, like, okay, let's say consensus was that gold prices are going to be at these levels, the margins are going to be at these levels, and it's going to persist for 5 years or 10 years, or actually going to increase. If that was the consensus, maybe these ounces in the ground would be trading at $1,000. Would that be like, oh my God, look, there's upside? Yeah, there might be upside because that might happen. But compare that to, it's like, okay, they're pricing in no chance of any of these projects actually getting into production, or if they get into production, there's no chance the margins will be anywhere near here. That's what I don't buy. I think, again, that even if that is a fear of the market, I mean, like always, it's like, oh, you fear something and the sentiment is already bad. Well, no price is too low to sell. I'm looking at how much I'm buying. I mean, if I can buy a project that could churn out 200-300 million of free cash flow and pay it back in a year, the initial capex, what is that worth? Maybe quite a bit. Maybe it's a long-lived asset, or I believe it's a long-lived asset. So I'm buying. It's like, okay, I'm buying 3 times the market cap in future free cash flow for 20 years or something. That's a pretty good investment. Where am I gonna find an investment like that in this day and age? Anyway, thanks for listening. Do your own due diligence. This is not buy or sell recommendation. Don't invest money you cannot afford to lose. I'm biased. I'm biased with every holding I have and every sponsor. And if I don't own it, I might, naturally I should be biased against it. Yeah, so again, it's like, if you don't see a case, absolutely don't buy it. You need to have a strategy that makes sense for you. Your buy and sell conditions have to make sense. You can't, in my opinion, just switch from, I'm going to be a trader, or I bought this because somebody liked it, then I'm going to sell because I'm trading it, or I'm buying it because the chart looked good, and then I'm selling it because I turn to fundamentals all of a sudden. It's like, it's up to you. You're the only one who has access to your portfolio at all times, so you have to know what the case is. But I would just leave with this notion of, like, it's never too late to start investing well, and the better you get, the more you get out of your dry powder. And also that, don't forget, this might look like nominal terms it kind of is, I guess, an exponential chart, but this is what 31% per year for 10 years looks like. So you could either be in all in London gold, or you could have a diversified portfolio that averaged 31% per year, and you would have exactly the same chart. Well, not exactly, but you get my point. So the idea was like, well, what does 10 bagger mean? Well, 10 bagger might mean that it averages 50% per year for 6 years, or 31% for 10 years and stuff like that. It's not a 10 bagger means that it's going to go up 100% every month. Anyway, thanks for listening. Bye bye.